Today I want to talk about bubbles, in particular stock market bubbles. And I want to share with you an article that I read recently. It's just from a few days ago by Howard Marks from Oaktree Capital. He is a fixed income investor, but he's been in the business for a very long time and has seen things in the market that tends to repeat itself. And he also issues these memos to Oaktree investors that he makes public, every couple of months or so. And this is the first one from 2025, and it was written on January 7th, so pretty recent. And the title of this particular article or this particular memo is called On Bubble Watch. And it's the 25th anniversary of another memo he wrote back in late 1999 about the dot-com bubble and its bursting. And he thought it was relevant and prescient to do another one 25 years later based on what he's seeing. He does reiterate that he is not an equities investor. He's strictly fixed income, but he's seeing patterns that can perhaps teach us lessons. So I'm not going to go through the whole article here, the whole memo. It's a very nice read, but it's going to take you some time. But I'm going to call some highlights out so that you can think about it as you're reading it and even think about it after you read it. So let's take a look at it, and then we'll just jump right in. So here's the memo. You can read it online, or you can download it as a PDF. And he also makes it into a podcast, so you can actually listen to it. And I think if you listen to it, it's about 35 minutes. But one of the things that jumped out at me on this one is this quote right here, that being too far ahead of your time is indistinguishable from being wrong. And this is basically saying that it's a play on that concept of that the market can be irrational longer than you can be liquid. Meaning that you can be making the right call at any particular time based on the macroeconomic environment and whatnot, but if you're making that call too early or too far ahead of when the market is expecting those set of facts or have come to grips with those set of facts, you might as well be wrong. That's what that quote means, and it really jumped out at me, and it really I take it to heart because it basically means that you can make the right call, but if the market doesn't feel that way and isn't with you, you may be paying a price. So that's one that jumps out at me. The rest of the article, he calls out some facts that I think is interesting. So we all know and heard about the Magnificent Seven, these high valuation growth companies. But one thing that jumped out at me when he calls it out is that these components are making up a third of the S&P 500 by market capitalization. As of the end of October, it's probably higher by year-end 2024. And to me, that's just bonkers. He did go back to before the tech bubble crash some 28 years ago, when the shares of those internet stocks was also top heavy, but back then it was only 22% of the index, whereas now it's almost 33%. So to me, that's a pretty significant jump. You go from 22 to 33. That's like a 50% increase. Does that mean that we are in bubble territory? Who knows? The other concept that he talks about is that a stock market bubble is really a psychological phenomenon. There are roots in quantitative analysis, but it's more psychological because people's expectations are being devolved and divorced from reality, from the quantitative reality. And he talks about a couple of things that kind of indicates that we may be in bubble territory. Things like highly irrational exuberance, thinking that a company can't do wrong at all. I'm probably thinking of the Tesla boys here, right? Because Tesla is in the Magnificent Seven. And no matter what the company is doing in terms of revenues and profits, the fanboys of Tesla will keep on buying. And Tesla is not the only one that suffers from this. So I don't want to just call them out, but that is that's one sign. Another one is that there's no price too high, because you think that this growth that you're seeing is going to go on forever. I think it's human nature to be optimistic. So I think that's interesting. The other thing that he points to is that of the Magnificent Seven that are in the index as of 2024, only one of them were even in that top 10 some 25, 30 years ago, and that's Microsoft. The rest of them are pretty new. And to me, that makes me pause and think that we do get into this trap where we think that whatever is hot and cool right now is going to continue forever. And whatever company or industry has the competitive advantage, that will never go away and it's going to be there forever. And I think that is a mistake. So I'm going to talk about NVIDIA because that's one of the hot stocks in the last year or two because of the AI boom, right? And the AI boom, in my heart of heart, I think is a real game-changing revolution, evolution for computing, the internet, and how we all work and perhaps even play. I think it definitely is. But who's going to become the winners of that? I don't know. Is it going to be OpenAI? Is it Anthropic? Is it Meta? Is it Google? Is it, who knows, right? But right now, the two winners are OpenAI, which is not public yet, and then NVIDIA, who are making the chips that power a lot of these large language models on the back end, right? And everybody loves NVIDIA for their chips, whether it was previously part of the GPU battles for video gaming or even crypto mining, and now it's the AI craze, and they're enjoying quite a ride. And I'm not saying that NVIDIA is not a good company or a profitable company or any of that. I bring up NVIDIA because I think about Intel. Back, some quarter century ago, right? Everybody thought that Intel was the chip king. I mean, when you compare it to the alternative, AMD at the time, Cirrus Logic, right? They all made the Intel clones, and none of them were quite as good as Intel chips. And Intel was the dominating chip for the longest time. Well, fast forward a quarter century, and Intel's still around. They're still a very valuable company, but they have most definitely lost the crown, lost its luster, and are not as great as they once were. That's just a fact, right? And when I think about that, and thinking back to when I was building my own computers and trying to decide what chip I want to get, is it a 486, is it a Pentium, what kind of Pentium? I didn't even think about buying an AMD chip. They were around, but I didn't think about it. And I just wonder if we're at that stage with NVIDIA. They look like they are the dominant king of the jungle and can never be dethroned, but we thought that about Intel as well. And 2.5 decades later, things have changed, right? So that goes to my mind. The other thing in this article, this memo that I think is really interesting, is this chart here, and I'm going to try to make it bigger and include it so you can see it more clearly. This is basically the monthly PE ratio of the S&P 500 and the subsequent 10-year returns from that point in time. And if you're looking at this, there's a very, very strong correlation among these 320 odd observations that the higher the PE, the lower the returns. And that has not been violated once. There may be some variations, but the trend is extremely clear. And the current level of PE for the S&P 500 indicates that we're going to see over the next 10 years returns between -2% to +2% on an annualized basis. That's pretty much flat. Is this time going to be different? I don't know. But that's the other scary thing, is that when someone does say that this time is different, you better be very careful. In any case, I highly suggest that you go and read this article or listen to it yourself, because I do think that it gives you some interesting things to think about. Like Howard says, he's a fixed income investor. He's not making predictions on equities and whether or not we are in bubble territory, but he sees some very strong correlation with historical facts that he wants to just bring to everyone's attention. In any case, thanks for watching, and I'll see you in the next one. Later.